Greetings, everyone. Our project was on the merger between Burger King and Tim Hortons. Our group members were Devin Parker, Max Pollak, Allison Soul, Cassie Chen, and myself, Aaron Lewis. Bit of background information for each of the organizations. Burger King is an American restaurant chain founded in 1954 with over 15,000 locations in 100 countries and is owned by 3G Capital. Tim Hortons is a Canadian breakfast chain founded in 1964 with over 4,000 locations in 9 countries and is known primarily for coffee and donuts. And some information on 3G Capital, the owner of Burger King. 3G Capital was founded in 2004. It's a private equity firm, and they have a relentless focus on cost efficiency. We have a snapshot of each organization's financial information at the time of acquisition, which is Q3 2014. We also combine them to represent Restaurant Brands International, which would be the entity created through the merger of Burger King and Tim Hortons.
Tim Hortons and Burger King officially merged on December 12, 2014, forming Restaurant Brands International. The arrangement came after a 99% Tim Hortons shareholder approval vote on December 9th. To note, Burger King did not require a vote. At that time, 3G Capital owned 70% of the firm. They also received a duly unanimous board of director approval. The deal was a $12 billion US dollar deal. It was financed through a combination of a debt financing package from JP Morgan and Wells Fargo and a $3 billion preferred equity financing commitment by Berkshire Hathaway. Berkshire Hathaway was purely a financing source, however, and they do not participate in the management nor the operations of the business. The corporate headquarters of Restaurant Brands International was set up in Canada. However, Burger King's operations remained in Miami, Florida, where they had been prior to the deal, and Tim Hortons in Ottawa, Canada, also where it had been previously. Under the deal, the two companies would continue to operate as standalone independent brands. The deal was structured as a cash stock combination consideration. However, Burger King shareholders had the added option to receive a partnership exchangeable unit for every share that they held. These are traded on the Toronto Stock Exchange and have the benefit of a delayed capital gains tax. Of these Burger King shareholders, 76% elected to receive these partnership exchangeable units, and 24% made no election. Those that made no election received 0.99 common shares and 0.01 partnership exchangeable units. Tim Hortons shareholders could elect between a cash-only consideration, stock-only, or a combination consideration. The combination consideration was 65.5 Canadian dollars with 0.80 common shares. The cash-only was 88.5 Canadian dollars, or a share-only option was 3.08 common shares. So 72% of the shareholders elected to receive common shares. 2% made just the cash election, and the remaining 26% actually made no election, which resulted in the mixed consideration. The offer value for Tim Hortons stock represented a premium of 39%. This is based on the volume-weighted average price of their stock over the past 30 days, with the time period ending on August 22nd of 2014. So while the deal attitude was described as friendly, it is important to note that certain conditions to the agreement existed. Restaurant Brands International, for example, had to maintain existing employment levels at Tim Hortons franchises. They had to maintain Tim Hortons as a distinct brand, as well as ensure that Canadians constituted at least 50% of Tim Hortons' board. To note, no employment requirements were placed on the larger Restaurant Brands International Board of Directors, and subsequently, only 2 of the 12 board members, which is equivalent to 17%, represented Tim Hortons. As with most mergers, there were multiple barriers to success present against the Tim Hortons and Burger King merger. These were present in the regulatory, social, and workplace environment. In regards to the regulatory hurdles, they had to be overcome in both the United States as well as Canada. Under Canadian law, the Competition Bureau reviews foreign-led investments and acquisitions of local assets to see if they provide a net benefit to the country's economy. On October 28, 2014, this bureau announced a no-action letter concluding that the transaction is unlikely to result in a lessening or preventing of competition in the fast food industry. However, it wasn't until December 5th of 2014 that the second part of this was received, which is the approval from the Ontario Superior Court of Justice. The United States' Federal Trade Commission, despite recent increased regulation on corporate tax inversion by the Treasury Department, also approved of the merger. So not only were regulatory hurdles faced, but it endured scrutiny from society as well as the government. By and large, Canadians were against the acquisition of their iconic brand, and they feared it would result in mass layoffs and tarnish the company. Tim Hortons was really not just another coffee company, it defined Canadians. Additionally, the harsh tax inversion criticism, which will be discussed later on, also led to PR barriers to overcome. Upon the deal proposal announcement, the hashtag boycott Burger King became a trending hashtag on Twitter. Additionally, the Obama administration and Congress strongly criticized firms that used tax inversion strategies, calling them corporate deserters for cutting into the U.S. tax revenue. And of course, the merging of two companies undoubtedly brings challenges in management practices, workplace culture, and day-to-day operation. The joining of Burger King and Tim Hortons, of course, was no different. Burger King, being run by 3G, focused on maximizing the bottom line and cash flows through cost-cutting measures. Tim Hortons, on the other hand, had a more familial approach. They were grown on friendships, and they created a web of closely knit executives. In fact, it wasn't uncommon to seal a deal with a handshake and nothing more. Through the merger, 3G translated their majority share in Burger King to a majority share in Restaurant Brands International, which allowed their methodology to reign supreme. Subsequently, many Tim Hortons executives departed early on, while 15% of the remaining were given their pink slips within the first few weeks. At Tim Hortons, new efficiencies were introduced, vendor relationships were challenged, and advertisement strategy was shifted. While Burger King and Tim Hortons were to be run separately, the 3G ideology quickly laid down roots, and Tim Hortons was left enduring the majority of the integration pains.
Despite societal and governmental negativity, the news of deal generated excitement within the financial market. The proposal of the transaction was on August 22, 2014, with official announcement following on August 26, 2014. Both the market price and value of both companies soared after the proposal and announcement. From August 22 to August 26, Burger King's stock price increased 15%, while Tim Hortons' share price increased 31%. Ruling out short-term market exuberance, stock prices remained high throughout the deal process, closing on December 12, 2014 at 98 Canadian dollar for Tim Hortons and $35.5 for Burger King.
Market conditions and strategic rationale leading to the transaction. Burger King wasn't immune to the five forces model developed by Michael Porter at Harvard. Burger King faced three strong forces and two that could be ameliorated based on the transaction. Buying power was always going to be there, as would the other two forces, but the force of consumers to be able to choose and develop loyalties for one brand or another was not going to be necessarily helped by this transaction. The threat of substitution or substitutes could be helped by this transaction. Due to the highly competitive arena of quick service restaurants, substitution can quickly lead to lost market share and therefore profit loss. Burger King needed to ensure their goods were unsubstitutable to maintain their market prowess. The second strong force to speak about was competitive rivalry, mainly that rivalry with McDonald's. Burger King and McDonald's go at each other, well, like what they say cats and dogs do. It's fierce. It's a battle to the end. Either company wants to do what they can to knock the other company down. McDonald's held a large share of the quick service breakfast. With numerous options for consumers, price wars and promotional incentives were an ongoing battle. 3G Capital, the Brazilian private equity group and majority owner of Burger King, focuses their investments on firms where they feel they can cut costs. After employing those tactics on Burger King in 2010, they were able to more than triple the EBITDA. Tim Hortons seemed an attractive target. With a motto of costs are like fingernails, you have to cut them constantly, 3G had numerous opportunities of this kind at Tim Hortons. With Burger King as a model, Tim Hortons' management headcount and costs could be decreased while improving effectiveness. The combined scale of Burger King and Tim Hortons could create negotiating power on pricing and payments terms with suppliers. Despite minimal supplier overlap, economies of scale could be created where possible. Furthermore, the franchise model could be leveraged to capitalize on the impact on gross margin. In August of 2014, McDonald's shares hit a 52-week low at $93.31, representing a narrow opportunity to gain share against a longtime enemy. Merging with Tim Hortons would allow Burger King to offset these strong forces and position the company as a potential marketplace leader. Acquiring Tim Hortons closed a noticeable hole in Burger King's offerings, namely its poor breakfast menu. It took a bite directly at McDonald's.
Evaluating Tim Hortons and Burger King's financial ratios and corporate operations provide further insight into rationale for the merger. Tim Hortons has been experiencing a slowdown in its growth rate from 12.48 in 2011 to 4.32 in 2013. Burger King's gross margin, net profit margin, and leverage ratio were all higher than Tim Hortons, while their asset turnover was considerably lower. The lower turnover and negative revenue growth rate of Burger King was largely a result of their strategy of refranchising restaurants. Burger King's high gross margin was also impacted by both the franchise model as well as the management focus on lean cost structure. By eliminating restaurant operating expenses by refranchising restaurants, corporate attention can be turned to decreasing selling, general, and administration expenses. Looking to improve their profit margins, adopting the franchise model as well as implementing 3G lean operating model could prove beneficial to Tim Hortons.
SWOT analysis is an important planning tool as it lays out a firm's or products or person's strengths, weaknesses, opportunities, and threats. So let's examine Tim Hortons and Burger King. Tim Hortons' strengths were an excellent ROE, ROA, and return on capital. They also had a stable free cash flow stream from 2011 to 2013. Some of their weaknesses are a low amount of liquid assets versus their current liabilities. We found that through performing the asset test ratio, and also management complacency. Burger King's strengths were a strong gross margins, and the majority of their locations were franchised, and they have a good amount of liquid assets found through the asset test ratio. Some of their weaknesses are a negative revenue growth from 2011 to 2013 and a volatile free cash flow from 2011 to 2013. Examining Tim Hortons' opportunities and threats, Tim Hortons has the opportunity to expand internationally and increase their enterprise value, as well as the opportunity to make improvements to their operations and cost structure. Some of their threats would be the fierce rivalry with competitors such as Starbucks, Dunkin' Donuts, and McDonald's, and also unforeseen changes to the economic climate. Some of the opportunities for Burger King would be the potential to expand beyond the Tim Hortons brand beyond Canada, and also the potential to improve operations, capital structure, and financial performance of the combined firm. Some threats to Burger King are their highly leveraged financial structure, as well as the fierce rivalry with competitors such as McDonald's, Carl's Jr., Taco Bell, KFC, and Pizza Hut.
This transaction included an inversion. An inversion is simply a redomicile or relocation of corporate headquarters that's done in connection with a cross-border M&A. The reasons behind this are clear. It's to capture tax savings. The tax savings come primarily in two forms. One, the U.S. has one of the highest marginal tax rates for corporate tax in the world at 35%. Canada's is a bit lower, adding up to a total of about 26.5%. But perhaps more importantly, there's also the ability to access capital that's earned in terms of foreign profits in a much more tax-efficient manner. The U.S. is one of the few countries in the world that employs a global taxation system, whereas most countries are territorial. Under the global system, any profits being brought back to the U.S. for distribution to shareholders or reinvestment are taxed at the difference between the foreign tax rate and the U.S. tax rate, whereas in most other countries this is not the case, including Canada, which has the aforementioned territorial system. So by doing this transaction and relocating corporate headquarters to Canada, the combined firm was able to lower their marginal tax rate and create much more efficient access to international profits, which are roughly half of the profits of the combined enterprise and growing quickly. This slide shows a number of examples of other companies who had accomplished corporate inversions in recent years leading up to the transaction, including names like Sara Lee, Virgin Media, and Liberty Global. And it also illustrates the positive market reaction to corporate inversions. The 5-day reaction ranged between 13 and 17% positive improvement in the share prices, and typically the acquiring firm drops in share price because of the premium they're paying to the existing value of the other firm. But here, because of the significant tax savings, you've seen why the stock market rewards companies who are able to accomplish this. Turning to our analysis of the standalone valuation of Tim Hortons, we looked at market trading ranges for the year leading up to the acquisition as well as the past 3 years to get a sense of where the market was valuing the company under various market periods. And then we conducted a discounted cash flow analysis based on the free cash flow projected for Tim Hortons. We looked at stage 1 growth of about 6.5%. And using inputs from the time of the transaction, we estimated the weighted average cost of capital for Tim Hortons at 7.5%. And we applied terminal growth rates ranging from 2 to 3%. This gave us an approximate valuation of $60 to $72. Turning to valuation based on peer trading multiples and looking at the PE levels of comparable firms in the industry, that gave us a implied valuation that ranged between $60 per share all the way up to $97 per share. And looking at this based on an EV to EBITDA multiple basis, which is agnostic to capital structure, it would indicate the value should be somewhere in the $60 to approximately $86 range. And then the last metric we looked at was precedent EV to EBITDA multiples for other quick service restaurants who had been acquired. This data we would call out as being the weakest and least relevant, as there were very few transactions and most of them were very small in nature. As we discussed, the benefits of this transaction go beyond the standalone value of Tim Hortons, but also include the tax benefits that the combined firm would reap. What we were able to see by 2016 is the combined company was able to reduce its effective tax rate down to 20.3% and capture the benefits of accessing international profits with less tax friction. We would estimate the value of these benefits could add roughly 10% to the combined firm, not just 10% of the target's value, but 10% to the combined entities. So a pretty powerful tax benefit from the combination of the two companies. One of the things we did to evaluate the success of the merger was to look at stock price performance from the close of the transaction for the following 2 years. We created an index, a market-weighted index of competitors in the quick service restaurant industry, firms that would include McDonald's, Starbucks, Wendy's, Sonic, Dunkin' Brands, etc., and looked at how our combined firm compared to those companies. What we see is a clear outperformance. The valuation of Restaurant Brands International has increased by approximately 35% over this period versus only 26% for the peer index and 11.8% for the market. Enterprise value is another way we can look at whether this transaction created shareholder value, and it certainly did. Tim Hortons shareholders who sold initially received a large premium, but those who held, as well as the shareholders of Burger King, who held the combined entity Restaurant Brands International, strongly outperformed the market and their peers. When we look at enterprise value of the two entities separately before the transaction, it totaled approximately $20.9 billion, but the combined firms had reached an enterprise value of $32.5 billion by the end of 2016, an increase of over 55% in just over 2 years. So a very valuable transaction for shareholders all around. The losers in the transaction would be Tim Hortons management, many of whom were phased out shortly after the integration in favor of the management team installed by 3G Capital, the private equity firm who is the majority shareholder of Burger King and continues to be the largest shareholder in Restaurant Brands International. And then another entity that did not benefit is the U.S. government, who loses another corporate headquarters and some future tax revenue due to the benefits of redomiciling that were achieved in this transaction.
And that concludes our presentation. We hope that you found the subject to be informative. Thank you.